Insurance is a mathematical contract for transferring risk. Most people treat it like a subscription service for bad luck, expecting a payout for a dropped phone or a dented bumper. But the system is built for a different purpose. We buy it because true financial ruin happens without warning. A severe medical emergency, an at-fault collision, a structural collapse. These events can wipe out decades of savings before you even have time to react. Protecting against every minor annoyance leads to a common mistake: bleeding your wealth over time. When you buy policies with tiny deductibles for manageable risks, you pay a massive premium for peace of mind you don't actually need. The secondary risk is even more dangerous. By exhausting your budget on minor coverages, you leave the big things underinsured. This leaves your life savings exposed to catastrophic ruin. This is the risk matrix. The bottom axis tracks likelihood. The vertical axis measures financial severity. Let's plot a house fire. The odds are low, but the devastation is absolute. It drops here. This high severity, low likelihood quadrant is the only mathematically sound zone for insurance. Optimizing your insurance portfolio requires a shift in mindset. You have to actively ignore the minor threats you can cover with cash and precisely match your policies to the exact vulnerabilities of your current life stage. Every insurance policy you buy comes down to a single mechanical trade-off: balancing predictable monthly costs against your out-of-pocket exposure when things go wrong. This chart illustrates the tension. If your deductible drops to $250, insurers take more risk, guaranteeing your monthly premium shoots up. Over a 5-year timeline, this inflated premium's cumulative cost often exceeds what you'd pay out of pocket for a flat $1,000 deductible. But deductibles are only half the pricing equation. Underwriters assess your financial risk using factors completely disconnected from how safely you drive or how often you visit the doctor. They rely heavily on your insurance score. This is a hidden risk ranking that insurers derive directly from your consumer credit history. Actuarial data shows a correlation between financial management and claim frequency. Consequently, a poor credit score downgrades your insurance score, flagging you as a higher statistical risk. Poor financial management outside your insurance life structurally inflates your base premium costs across the board. To control your out-of-pocket costs, you need a dual strategy. Select the highest deductible you can comfortably float in cash from your emergency fund and aggressively maintain strong external credit. When applying these rules to homeowners or renters insurance, you must watch out for a hidden vulnerability in standard policies regarding how payouts are calculated. Imagine a hurricane or fire leaves your home flattened. When the damage is total, getting the payout math right is critical to your financial survival. Many basic policies calculate your claim using actual cash value, or ACV. This method aggressively subtracts years of depreciation from the payout for your damaged items. An ACV policy is cheaper to buy up front, but when disaster strikes, it yields garage sale prices for your older assets. This leaves you unable to afford brand new replacements at today's retail prices. The alternative is an endorsement called Guaranteed Replacement Cost Coverage. You will pay higher premiums for this upgrade. However, it neutralizes the risk of post-disaster inflation and building material shortages by paying whatever it actually costs to rebuild your property as new. You face a similar math problem with auto insurance. State laws require minimum liability limits, but those minimums are often a fraction of the true cost of a major collision involving medical bills and multiple cars. Carrying only the state minimum leaves a massive gap in your protection. If you are sued for an amount that exceeds that low policy limit, your personal assets, including your home and life savings, are legally exposed. Bargain hunting for property and liability insurance is a trap if it saves you $20 a month, while exposing your accumulated wealth to predatory lawsuits or crippling construction inflation. Your capacity to earn an income over the next 20 or 30 years is your most valuable asset, far exceeding the total value of your home or car. If you lose your job, you instantly lose the employer subsidy paying for your health coverage. Many people rely on a federal law called COBRA to keep their plan active, but COBRA creates a massive cash flow friction. It forces you to pay up to $102. Term life insurance is a tool designed purely to replace that income. The trade-off with term life is straightforward. It provides a massive, high ROI death benefit for a specific, vulnerable window of time, like the 20 years you spend raising kids. But it accumulates absolutely zero cash value. Because of that, many sales agents will push whole life policies instead. But for people seeking basic, affordable income protection, whole life is entirely unnecessary and incredibly expensive. Finally, what if you are severely injured but you survive? Here, disability insurance comes in, and you have to look for a crucial nuance in the contract called own occupation coverage. Own occupation coverage is significantly more expensive, but it guarantees that your income is fully replaced if you cannot perform your exact highly trained profession. It prevents a specialized surgeon with a hand injury from being denied a claim just because they could technically work a minimum wage desk job. Evaluate human capital policies strictly on their ability to replace decades of future compounding earnings. To put all these mechanics together, map these trade-offs directly to your current life stage and risk exposure. This chart lays out a 3-tiered progression model. We can divide your needs into 3 different profiles: the baseline for the young and single, the protector for families with assets, and the enterprise for business owners. If you're young and single, you need the baseline. This requires high-limit auto liability to protect your future wages, baseline health insurance to avoid medical bankruptcy, and renter's insurance to cover your personal property. Your strategy here is risk retention. Take the highest deductibles your emergency fund can handle to crush your monthly premium costs, and skip life insurance entirely because no one relies on your income yet. Once you buy a house or have dependents, you upgrade to the protector. You maintain the baseline, but add term life, long-term disability, and guaranteed replacement cost for your property. As a protector, you are paying a premium to guarantee your family's standard of living survives your death or injury, rather than relying on minimal employer-provided group plans. Finally, if you run a company, you enter the enterprise tier. This requires establishing a business owner's policy, or BOP, as your commercial foundation. A BOP will give you a discount by bundling property and general liability. But as an owner, you must actively buy separate workers' comp and professional liability policies to shield your personal, at-home assets from corporate lawsuits. Insurance companies generate profit by managing risk mathematically. Consumers must do the same. Transfer only the catastrophic risks that would cause ruin, while retaining the risks you can afford.